Let me now bring on board Gautam Chachuria, head of India Research, Small and Mid Cap with UBS. Gautam, first a word on the big picture. The price action in last 2 or 3 days for Indian market has changed. Are you advising your clients that ahead of key events like UP elections, union budget, credit policy, it is time now to book profits and exercise some caution?
Good morning. No, we have been positive on the Indian markets for this year, and the primary reason is three for being positive. To begin with, unlike last year, this is a monetary easing year. Secondly, we expect the political and the policy-making environment to be better post-elections, and in our view, election getting over is a bigger overhang behind us rather than the outcome. And thirdly, and the most important part for market is also the earnings part. We have seen earnings being cut almost 13 to 15% from peak levels for March 12, March 13, and now we're looking at earnings to bottom out and growth to pick up. Compared to 8 to 10% for FY12, we're looking at almost a 15% earnings growth for FY13, and primarily based on conservative assumptions. So that should support market valuations here. And again, in the near term, again, we will always have issues like crude, etc., which will remain a risk element for Indian markets, which we saw over last week or two, where the higher crude prices led to investors again booking some profits. So that will continue, but as crude stabilizes or doesn't really spike up from here, I think markets will get support at these levels.
So Gautam, if you are of the view that after a 20% appreciation in this calendar year, this market is still looking attractive, where should investors, both medium term and long term, should put their money to work to maximize returns?
Yeah, and I'll just to put a perspective, when you look at markets going up 20%, it's also after the sharp correction seen in November, December. And if you look at these two big sharp move down and up together, you're basically looking at the tail risk which was being built into Indian markets towards the end of last year. The fading away of that tail risk is what we have seen this year. It's not really markets going up in anticipation of big up moves in earnings or big recovery in India. It's more that fading away of the tail risk which we saw in November, December. And from here on, obviously, the more fundamental aspects come through, which is the policy making from the government and most importantly from earnings. And there again, what we typically do is also compare past valuation trends and the earnings outlook, and also where the sectors are looking at. So if you look at that, the sectors which look attractive compared to recent historical trading ranges, and where we have seen some positive earnings momentum over last 2 to 3 months, is primarily consumer discretionary and financials. And also, if you look at 6 months, 12 months from here, we are positive on industrials and infrastructure space.
So Gautam, which companies, or rather which banks would you be most bullish on? When you talk about financials, what is the rationale? Is it just a valuation play, or do you think once the RBI does decide to ease out on its interest rate trajectory, you will see financials outperform in any case?
No, obviously, easing out of RBI is a key catalyst, because even now, despite the market rally, etc., the liquidity environment remains tight in India, and we're still looking at slow, compared to history, credit growth even this year. But again, valuation is obviously a big one. It's a key support metric for financials. And again, if you look at the broad financial sector, unlike in the past, one big issue this cycle is the NPL risk is much higher compared to the past down cycles. In that context, we are much more bullish on the private sector banks, and specifically the names which we like most there is ICICI Bank and some of the smaller banks like IndusInd or even Federal Bank or even Axis Bank.
Gautam, it's very interesting to see that you've got a buy call on L&T and you're also bullish on BHEL at a time when the market is punishing both these names for not just the earnings but for the fierce competition which is building up in the space. What makes you so bullish on these names?
One, if you look at top-down, whatever market has been punishing them is more backward-looking. And again, when we're looking at monetary easing as well as gradual economic recovery in India, for which again recovery investment cycle will be a key element of that, these two should benefit top-down on that. Specifically for BHEL, again, If you go back to the early part of the decade, we had similar concerns about BHEL, not necessarily on competition side, but also in terms of order flow outlook, because power sector was in a mess. Now, on that context, again, we have seen early signs of government efforts towards reforms in the power space. If that momentum continues, and it bodes very, very well for power space over the next 5 years, which obviously BHEL is a key beneficiary of that. On the competition side also, we believe that BHEL does stand out. We do believe that BHEL is significantly ahead of competitors in terms of their cost competitiveness, and they have a margin advantage. So even the competition is going up. It's not that BHEL is on a back foot. It's the biggest player. It has the advantage of scale. It has the margin advantage. And for other players which are much more leveraged, have more higher cost capacities, it will be tough for them to compete with BHEL. So a lot of the pessimism which market is punishing them on, I think is a bit overstretched.
Gautam, if I look at absolute numbers, for the month of Feb, Indian markets have got about 25,000 crore of fresh inflows. That is some kind of a record. But the net change for the Nifty in the month of Feb was only 2.8%. Now, are markets getting tired because there is liquidity and the price appreciation is not strong?
Again, you can't have markets going up in one way. So you'll always have bouts of profit taking and corrections, and there are various factors that play, like crude or even global factors. But again, when we try to take a view on the market, it's more a 6 to 12 month kind of view, on which all the parameters we discussed earlier, they seem to be falling in place to support markets at current levels, at current valuations, and even support move up from current levels. Yeah, but markets will look at booking profits, etc. in the short term whenever you have a sharp rally.
Let's talk about an area in which you specialize, the small and the mid-cap space. So from the small and the mid-cap space at UBS, what are your top ideas for the year 2012?
We have a model portfolio going, but again, to highlight from that, top names which we like for this year is Coromandel, Bajaj Electricals, Pidilite, Imami, and VIP. These would be the top 5 names. And again, if you look at all these 5 names, the common theme is that they have strong business models, which have inbuilt growth and margin stability for the longer term, but which the stocks have been impacted in the short term due to specific one-off quarterly issues, which we don't think are structural. It's more a short-term issues, and therefore these stocks are quite attractively valued.
As a theme, as a top-down sector, you like infra, but the small-cap names you mentioned, Imami, Pidilite or Bajaj Electricals, they are not from the infra space, they are from the consumption or the FMCG space. So why is there a disconnect?
Yeah. It's not a disconnect really, because a lot of the small-cap names or coverage which we have is primarily based on bottom-up rather than top-down. While when we discussed earlier, it's more top-down from our markets as a whole. So a lot of the small-cap coverage which UBS has in India is primarily based on bottom-up ideas. And again, if you look at infra space, we do have coverage on a lot of mid-cap, small-cap names there, and they do appear deep value. But again, in that space, typically, because it's a longer cycle, it takes longer to play the cycle out. At the early stage, you typically want to get into the larger caps there, and then get into the smaller caps, because as visibility builds in, then you get more comfort on the mid-cap, smaller cap names. Because typically, again, a lot of these names in that space are highly leveraged, both operationally, financially. So you can get a big bang for the buck initially if you want to take a risk, but from a risk-reward perspective, we prefer to get into large caps initially.
Gautam, you also have names like VIP as well as Jubilant Foodworks. Are valuations not a concern, or do you think the growth that these companies would post would, sort of more than make up for anything else?
And we actually have a sell on Jubilant Foodworks, so where we don't have comfort on the valuations. But again, we're looking at growth as well as the quality of growth when we look at names and look at recommending these names. So the return ratios and cash flows are equally important.
Gautam, we didn't get a chance to talk about ONGC. After the temporary nervousness in the stock, what is it that you make of the auction, considering, the government was hoping that it would strike at a premium, but hasn't quite happened? Still a lot of confusion on what happened to those 12 crore shares, which then LIC came in and bailed out. What is the long-term trajectory for ONGC? Because the bigger concern is, with the crude prices still on pretty much an escalated trajectory, subsidy is always going to be an issue.
Yeah, so I'm not an expert on what happened on the dissolution process yesterday, so I won't like to comment on that. But basically, fundamentally, the bigger issue for ONGC is the subsidy regime. And given the government is anyway fiscally challenged right now, so we don't really see government having too much leeway in terms of structurally changing the subsidy burden on companies like ONGC. So they do remain under that overhang. And we have to see that overhang going away before ONGC re-rates in any meaningful way longer term.
Gautam, hypothetical question. Let's say if you get a call from a client and the conversation is that I missed the rally this year, what should I do now? So what will you advise that client?
No, we keep getting that question. So we keep telling investors that if you look at 6 to 12 months, the market does look good, bottom up. And the primary reason, one of the biggest reasons markets do move in anticipation of earnings growth. And if you look at last 2-3 quarters, we have been seeing earnings momentum to be very, very negative. Earnings have been cut 12 to 15% top down for FY12 and FY13. And that always affects market valuations. In that context, if you look at next 2 to 3 quarters, you might be looking at the last leg of earnings being cut over the next 2-3 months, and then you see earnings bottoming out, and the earnings growth outlook for FY13 is significantly better than what we saw in FY12. And that should be supportive of both market valuations where we are at now, as well as markets moving up higher. Because one thing you'd always remember for India, that even FY12, which is really a bad year in terms of macro, global, local, etc., we still are seeing earnings growth this year, and that should accelerate next year. And therefore markets will go up from here. Are
you looking at revising your Sensex target for this calendar year and next calendar year, or you only want to do that after the budget?
We don't really have a formal target for Sensex and Nifty because we focus a lot more on the relative positioning of different sectors and stock ideas and direction of the market. So again, no formal targets, but yeah, we remain positive unless we see a real big oil shock for India, which is oil spiking up significantly higher from here. X that, no, we broadly remain positive on the markets.